waiting around to find a target. And the answer is this is a structure that enables us to take a large company public in an extremely efficient manner. For those of you who follow SPACs, there are no founder shares, there are no underwriting fees, there are no shareholder warrants. These are all very dilutive instruments that contribute to SPACs' sort of underperformance. The only economic difference between us and the other participants in the SPARC is that the sponsor, which is in this case the Pershing Square Holdings and our other two funds, gets a warrant on up to 5% of the shares of the company, struck 20% out of the money. So it's a very efficient, interesting way to go public, and we can guarantee to the counterparty that it's a certainty they're going to go public, subject only to the SEC approving a prospectus. We can guarantee the price per share, obviously the valuation which the business will go public, and we can commit a couple $1 billion from our own capital, so they know they're going to raise a minimum amount of capital. So it's a very attractive vehicle. So the question is, why haven't we done a transaction yet? And the answer is, it really relates to why have there not been more IPOs? You have this buoyant economic environment, rates are reasonably low, everyone's interested in investing in IPOs, there aren't a lot of IPOs. The reason for that, in my opinion, and the reason why we haven't done a SPARC transaction, is that the private market carrying values of both private equity companies and venture-backed companies, in many cases, are above where they would trade in the public markets. And so the private equity sponsors and the management teams and the shareholders don't want to get a public mark, right? And so therefore, they're kind of waiting for the business values to grow enough so that by the time the companies are ready to go public, they can actually trade them. And we're looking to buy a very high quality business, but we have to buy it at a price that makes sense to us as a major shareholder of the company, where the SPARC investors get the benefit of a nice uplift at the time the company goes public. And I think what happened was we were in a very low interest rate environment, we were in a very buoyant venture environment. Companies raised a lot of capital, valuations were set, and then rates went up a lot. The kind of bloom went off the rose, so to speak, in the venture-backed business. And so if you're sitting with a private equity portfolio or a venture portfolio that's carried at a certain level, I think you should look askance at some of those carrying values, because I think they're above what the businesses are worth. And we need that those stars to align before we can do the transaction. But we are actively talking to people, looking at transactions, and so in terms of where it fits. So let's assume for a moment we get our Howard Hughes transaction done. We're going to have the Pershing Square, and let's assume PSUS gets done. So we'll have a public securities strategy where we buy minority stakes in large cap public companies like Uber and Universal and businesses like that. That's at PSH, PSUS, and the two small Pershing Square hedge funds. We're going to have Howard Hughes, which is going to buy private companies of relatively modest size because of the scale of that entity. It's like a $5 billion equity, $4.5 billion equity company. And these are control investments, so controlling interest in public companies, 100% interest in private companies. And then we're going to have SPARC, which is a vehicle we're going to use to take private companies public, generally large cap private companies of a kind that would fit into the PSH portfolio once they become public. And so the good news is none of these strategies compete